Hello, my name is Sushil Kumar Singh. I have more than 10 years of experience in investment banking. This presentation will talk about financial institutions and their assets. We will define financial institutions and will have a look on its working capital. Then we will touch upon major financial assets. So what is financial institution? An entity which pools surplus assets or funds from savers, lenders, investors, and channelize these funds who wants those funds, so borrowers, for their businesses. Based on primary sources of funds and its uses, we may divide financial institutions in three broad categories. Depository institutions. They accept deposits from individuals and businesses and make loans. Examples are commercial and saving banks, trusts, credit unions. Second category is contractual institutions. These institutions receive funds on a periodic basis and lend these funds in such a way that contractual obligations are met. Contractual obligations like providing life insurance, retirement benefits, etc. Obligations are generally long-term, so these institutions generally invest in corporate stocks, bonds and mortgages. Under this category we have insurance firms and pension funds. Last category is investment institutions. These facilitate various financial activities by individuals and corporates according to their objectives. Institutions under this category are investment banks, hedge funds, mutual funds, underwriters, broker and dealers. Bank of America works as a depository institution by taking deposits and providing loans, credit lines. So these are kind of depository function of Bank of America. It also works as contractual institution by providing insurance protection, so like investment protection, financial planning. So these are like contractual, these are functions of contractual institution. It also works as investment institution by facilitating investment, merger and acquisition, trading. So how's capital structure of Bank of America? So first, shareholders equity. Shareholders borrow money from market in the form of debt. Debt and equity are companies' liabilities which fund various financial activities of institutions. These are called financial assets which generate future incoming cash flows. Part of future cash flow will be retained and will be part of business capital. The rest of future cash flows will be part of dividend, interest to debt holders and operating costs and other costs. So let's look at financial assets. As we have seen, investors have surplus funds, so they provide those funds to issuers and issuers issue assets. Investors claim future cash flows from these assets. Examples are like a loan provided by Bank of America to individual to buy a car. The individual borrower prepays the loan in form of principal plus interest via equally monthly installments. Similarly, a government issues a bond. Investors in these bonds get regular coupons and principal repayment in fixed terms. Investors may also buy shares from the stock market. An investor can also hedge its risk by buying or selling derivatives. So we have seen two main economic functions of financial assets: fund transfer from investors to issuers and redistribution of risk associated with cash flows generated by assets. So this ends our presentation. Thank you for your time. Please share your feedback and suggestions at sushilp.iitk@gmail.com.